Dear guests, thank you for joining us here today in Europahuset for a discussion on a highly relevant topic, energy transition in Europe, and in particular the Swedish perspective on how this is unfolding. My name is Cecilia Torfin, and on behalf of the European Commission's representation here in Sweden, I'm very, very glad to be able to welcome you here today to Europahuset and say a few words of introduction before I hand over to our keynote speaker. And first, maybe some of you are joining us here in the room or online for the first time in Europahuset. So I just want to say a couple of words about our role here in Sweden. As a representation of the European Commission, we are the eyes and the ears and the voice of the European Commission and engaging thus in many, many ways with stakeholders and the general public in Sweden. And we have a particularly busy time now during the Swedish EU presidency, since it is our role to take good care of all the commissioners who are visiting, for instance, the informal council, such as the one happening today. And this week we set a record. We have 6 European commissioners visiting Stockholm actually in these days. And that is why our head of mission, Mrs. Weppling, couldn't be with us today, but she obviously sends her warm regards to all of you. We also have in our mandate to foster dialogue, to be a platform here for discussion about Europe. And that is why I think an event like today is particularly important. And I really want to thank the EIB and the SEB for reaching out to us and suggesting that we do it here together. Because the topic we're going to talk about today is truly a challenge that has a European scale. It really concerns Sweden, and it can only be solved if European institutions, national actors, and of course also the private sector engage and solve this problem together. And also a very special welcome to all our prominent guests today, including State Secretary, for example. So energy issues have, of course, taken the central stage in the European Union already for a few years. We saw the von der Leyen Commission, when taking office in 2019, putting the twin transitions of energy and digital transformation top on the agenda, with the regulatory steps being proposed in the context of the Fit for 55 package, which the Swedish presidency is now working very hard to actually really bring home, as we say, when we finish the legislative process. And with mobilizing considerable funding for inter alia, the energy transition from the different envelopes of the EU budget. And then, of course, history took another course. And since 2019, we have experienced these crises of proportions we couldn't imagine. First with the pandemic that made energy prices soar. And then since last year with the illegal aggression that Russia is doing in Ukraine, and also weaponizing really energy as a way to put pressure and attack the whole of Europe. And with that, we were brutally exposed to the geopolitical necessity as well to quickly diversify and find other ways to meet our energy needs other than importing Russian gas. And I find it very important and very encouraging actually to see that in spite of these crises, in spite of the pressure this of course put on the political system we operate in, we haven't lost track of this goal set in 2019 to pursue a twin transition. Actually, the crisis has leveraged, in a way, put more funding, like the Next Generation EU instrument that was set up after the pandemic to leverage the energy transition. And the very ambitious Repower EU proposals, you will remember, were tabled about 1 year ago. These targets have been met and even exceeded, and that is quite impressive given the short time frame that has passed since then. And the Commission has also continued to keep up the momentum and has tabled new proposals. We are, of course, approaching a European election next year, so we cannot make too many new initiatives to have time to bring them around before we have a new legislature in place. But I want to mention in particular 3 proposals that the Commission has tabled in recent months that I think are of particular relevance for you here today. The proposals of last March to reform the electricity markets is one of them. The Critical Raw Materials Act, which will be very important to make sure that we can source all the materials we need inside and outside Europe to actually also implement the energy transition. And the new fiscal rules that were proposed by the Commission only last week, and which provide us with a greater flexibility for new investments in the energy transition and the green transition more largely. And of course, there are many, many challenges that still need to be tackled together, not at least the conditions for private sector investment, which I know are of particular interest to all of you here today. And we can and we should continue to act at EU level to provide financial resources that complement private investment in the energy sector. And the EIB has, of course, taken a very, very important role here, being the EU's climate bank. And I know that there are several work streams already underway where the European institutions and the EIB are progressively deepening also this relationship, such as the Recovery and Resilience Fund, the Repower EU, and the Innovation Fund and InvestEU. And in the medium term, we also from the Commission side wants to boost the investment through a new EU sovereignty fund that should be proposed later this year. And finally, I'm sure you're all aware that we are working hard with the Biden administration to minimize the unintended and potentially harmful aspects of the Inflation Reduction Act through the joint EU-US task force. Very important, of course, also topic for Sweden to see how we deal with competitiveness from this perspective, and I know not least for the Swedish government. So today, I really hope that this exchange will be fruitful for everybody involved. And with these short remarks of welcome, it is now my honor and pleasure to introduce you to Carolina Ekholm, who is the Director General of the Swedish National Debt Office for your keynote presentation. And after that, we will welcome Robert Bergqvist, Senior Economist at SEB, to moderate the rest of the discussion. I wish you a very interesting morning, and once again, a warm welcome to Europahuset.
Thank you for those kind words, thank you for the invitation and opportunity to speak today. As you can tell, the title of my remarks is Optimal Economic Policies in a Polycrisis Environment. And that may sound like somewhat difficult topic to address, considering optimal policies in such an environment. It's a little bit like considering what is the optimal way to steer a ship that has happened to come across a storm in a very bad spot where there are dangerous rocks all around. And I think this analogy sort of clarifies that one important issue here is to understand or try to clarify, what is the objective in this kind of situation? What is the best you can hope for? And if you happen to be on a ship in a storm in a bad spot, the best you can hope for is that you get out of this situation relatively unscathed. That is, with everyone surviving on board and with the ship that is still operational. And if we make the analogy within economy, I think one can note that there are two things that are relevant for having an economy go through a crisis or a polycrisis relatively unscathed. And the first thing is to avoid letting any underlying weaknesses in the economy feed into the various crises that the economy is facing with new fuels, so that this crisis becomes systemic and brings down the whole economy. And the second thing is to avoid what we economists call scarring. And with that we mean that the crisis have persistent impact on long-run output of the economy. So that I would claim is the objective when you think about designing policies that are well designed for a polycrisis situation. And let me elaborate a little bit on these 2 points. And I'm going to do so with an example. And the example is the Euro crisis, which, of course, may feel like something that happened in history at this point, since we have gone through so many crises since then. But there is a point to this, so bear with me. When Europe was hit by the global financial crisis around 2008, there were certainly weaknesses in the euro area in place, and they had been, in principle, in plain sight, were the build-up of these weaknesses. So on this slide, you have two graphs. So on the left-hand side, you see current account balances for what became crisis countries, Greece, Italy, Spain, Portugal. I haven't included Ireland, which is a little bit of a special case. Germany is there also. And one noticeable development from the introduction of the euro is that these countries that became crisis countries, they started running significant deficits in the current account. And as you can tell, on the other hand, a country such as Germany was running significant surpluses, and so did some other countries in Northern Europe. What this means is that there were significant capital inflows into these southern European countries, and at least this suggests that some of these capital inflows stemmed from countries such as Germany. And these capital flows in themselves, I mean, there's nothing strange with that. There was certainly a situation where southern European countries should have been catching up and allowing capital to flow from the north to the south would enable savings from countries such as Germany to potentially earn high returns on productive investments in a relatively capital scarce southern Europe. However, that's not exactly what happened, and that is partly shown in the right hand, or the diagram on or the graph on the right hand side, which shows unit labor costs, how they evolved in index form. And unit labor cost is a measure of competitiveness. And as you can see from this diagram, there was a successive increase in unit labor cost. That means a loss of competitiveness in the southern European countries. In Germany, unit labor costs were quite stable. So wages were increasing in these countries, but productivity growth did not really match wage growth, and there was a successive hollowing out of competitiveness. It turns out that a lot of these capital flows into these countries were actually directed towards the real estate sector. And this was perhaps most clearly the case in Spain, where you saw a boom in the housing sector, a boom in the construction sector, increased indebtedness in the private sector. And of course, these types of investments didn't really contribute much to productivity growth. Another development that I think is relevant is the compression of spreads on sovereign bonds. So this diagram shows you spreads on sovereign bonds for the crisis countries vis-à-vis German bonds. And as you can see, before the global financial crisis, these spreads were very, very compressed. So these countries could essentially borrow at the same with the same costs as Germany. And these are countries, of course, where the need for public investments are very significant. So no wonder that this also led to government borrowing that, I mean, at least it didn't make public indebtedness go down. And for most of these countries in Southern Europe, they were already at a level of indebtedness where debt ratios were significantly above the threshold level of 60%, according to the Stability and Growth Pact. Not Spain, though. Spain was the exception. It actually had very low public indebtedness at the outset of this crisis. But anyway, when the global financial crisis hit Europe, there were these weaknesses in place, macroeconomic imbalances that contributed to the loss of competitiveness in Southern Europe. We had house price booms, increased indebtedness, and this, in the end, as we all know, evolved into a full-blown debt crisis that had much worse consequences for the real economy in parts of the euro area than in the United States, where the financial crisis was emerging from. So how was this ended? I mean, it's clear from this graph that eventually things seem to have subsided, at least when it comes to interest rate spreads. And a significant event was, and I mean, it's clear from the graph that something happened around 2012. There was this significant event in the summer of 2012. A very particular event was that Mario Draghi, the then president of the European Central Bank, went to London. He held a speech and he said, per usual, or as was usual, that the ECB was going to do whatever it took within its mandate to avoid a disintegration of the Eurozone. For once, it was perceived as credible. He sort of added off the cuff that, believe me, it will be enough, or something to that fact. It was followed up in early fall that year with a new facility or a new tool developed at the ECB, whereby the central bank could buy government sovereign debt from euro countries unlimited under certain conditions. It's a tool that has never been used, which should be viewed as quite a success story. But things simmered down. Still, the consequences for the real economy was very, very severe. So here is this slide shows you development regarding unemployment. Here you also have one of the curves shows Sweden. We here in Sweden thought that unemployment was rising dramatically when it went up to around 9%. But as you can tell from this graph, in countries such as Greece and Spain, we're talking about unemployment rates of about 25%. So here we are coming to this scarring issue. Of course, experiencing unemployment evolving like this means a lot of scarring for the economy. And a contributing factor to this scarring, I would claim, is the significant fall in investments that happened in the aftermath of the global financial crisis. So in this graph, you see aggregate investments as a share of GDP. And as you see, there's a very significant decline in the crisis countries in connection with the emergence of the euro crisis. I mean, obviously you may argue that some of these ratios were a little bit bloated before the euro crisis, like in Spain, for instance, that had this booming real estate sector. But still, these depressed levels of investments in these countries lasted for a very long time. And this was in spite of the fact that I know that the European Investment Bank, which of course is an important contributor to this seminar, they were very active in trying to do what they could to mobilize investments and utilize the competence that they have in terms of project funding to remedy the situation. But this was certainly part of the scarring. And this leads me to my conclusions regarding what policies are important to get an economy relatively unscathed through a situation where you have crisis all around. And to begin with, it is important to introduce powerful policies that put a stop to crisis dynamics that can have self-fulfilling elements to them. And it is very important to be clear about your intentions regarding that, and present your measures in a way that is credible. And if the tools that you develop in order to stop a crisis dynamics are never used, so much better. Secondly, it is important with measures to support investments to avoid scarring that reduces long-run output for the economy. And now I come to my point. In doing so, several of the institutions that are represented here today have important roles to play. And that goes for commercial banks, such as the SEB. Of course, the commercial banks are very important in this context, since they are the most important institutions for credit intermediation in Europe. But also international investment banks, such as the European Investment Bank, that are owned by members which are sovereign states, and they have their capital both paid in explicitly, but also guaranteed in various ways by sovereign states. They have important roles to fill in order to take some of the risks of other investors in situations where there's a lot of uncertainty and perceived of increased risks. And also, of course, these kinds of institutions have over the years accumulated a lot of competence and knowledge regarding project financing, so they are well placed to also steer capital towards productive investments. And then finally, the institution that I myself represent, which is a national debt office, which is an agent for granting government guarantees. That's also a powerful tool to lift off some of these risks that emerge in a polycrisis environment, and that can be a very powerful tool to maintain reasonable levels of investments. So the final conclusion is that we who are represented here today, we are very important to minimize the negative consequences of finding ourselves in a polycrisis environment. Thank you.
Great. Thank you very much for this introductory speech. Very interesting. I guess now we have two pessimists on the stage. Or what do you say? I think your message was quite pessimistic.
Do you think so?
Yeah, I think so. Yeah.
I'm talking about how to deal with crisis, and I have an idea how to do it. So I view that as quite optimistic.
We will continue to have this discussion during a panel, and I will also invite to other panelists to continue this discussion. But if I look at the current investment environment, I think it's very challenging. You're talking about systemic crisis, and to me, a kind of systemic crisis that is that all countries will be affected around the globe. And today, I think you could say that we have, looking into the future and today's situation, we have a kind of systemic crisis with the climate. We have a systemic crisis with a pandemic because we are just waiting for the next pandemic. And when you look at the geopolitical situation, we have a new security order. Do you agree that we have these kind of very big polycrisis environment that will be very challenging for investments, looking into the future?
Yes, but potentially that's the normal state of the world. I mean, it could be that obviously we've had periods of very sort of stable macro environments, for instance, but that may be more the exception than the rule. And very frightening geopolitical situations we've had before. The climate challenge is, of course, a very significant one that needs to be dealt with, and obviously that's you could definitely worry regarding the effectiveness with which the global community is dealing with that type of crisis. But if you look at the pandemic, I mean, the world economy essentially stopped for 1 quarter or maybe 2. And then there was a very quick bounce back. And of course, there is this aftermath with increased inflation and so forth that is partly driven by trying to adjust after having been in lockdown. But I would view the way the pandemic was dealt with as a success story.
I think we will come back and talk more about the financial stress that we have right now. Because if I look at coming back to this description of the world, when we're talking about pandemic as a systemic risk, geopolitical situation, the climate crisis, I hope that we don't have to add another systemic crisis, and that is the financial system, like we had in 2008. But I think it's time to invite other guests for this panel to continue the discussion. Thomas Östros, please join us on stage, Vice President of EIB. And then we have also Johan Torgeby, please, CEO and President also of SEB. I would like to start ask you a question about the current situation when it comes to the financial stress. Are you worried about the situation that we see right now? If you look at, well, we have the US banks and we have the situation for Credit Suisse and some people are actually telling that maybe we are coming closer to a kind of new 2008 scenario, this kind of Lehman collapse. How do you look upon the current financial stress? I would like to begin with you, Carolina.
Yes. So the way I look at it is, okay, so we had a long period, it was very stable. We had low inflation, low interest rates. It lasted for a sufficiently long time for everyone to get maybe a bit complacent and organizing their thinking around this is what the world looks like. Then things change quite quickly. So inflation is high, interest rates have gone up considerably. At some point there will be potentially a new sort of stable macroeconomic environment that probably looks a bit different from the one that we come from. But we're still in some sort of transition, and in that transition things can happen. I think in Sweden everyone would worry about high indebtedness in the private sector. It's the households, it's the commercial real estate companies that have increased their indebtedness during this period with low interest rates. So I think from a government agency point of view, we would definitely follow the whole time what's going on there. But the events that we've had with stress, or I wouldn't call it crisis, but certainly stress, that those instances haven't really been related to the increased indebtedness in the private sector. We've seen other things going on. I mean, here in Sweden we had some stress in the market for electricity derivatives that came a little bit out of the blue. In other countries we've seen, we had the UK in the fall with their mini budget. They had increased interest rates on government debts on the basis of that, and it turned out the pension companies had been also in the derivative markets in a way that created vulnerabilities. So there have been other things going on, and then we've had these banks failing lately that partly, I think, is due to them not having taken into account this change in environment. But not only, I mean, Credit Suisse is just probably a bank that was badly run for a number of years, and then at some point they lost the trust of their customers and depositors. So
you are not that worried about the situation, that what we see is happening right now?
No, I mean, I absolutely think that there may be further things along, when we move further along to a new, more stable environment. But it's very difficult to say what it is going to be.
Thomas?
I would say I'm concerned. I mean, what our experience tells us is when relative prices changes dramatically, things can go really badly. I mean, you remember from the early 90s, we went in Sweden from a persistent high inflationary environment. A short period, we went to low inflation, real interest rate exploded, and suddenly we were in a mess with the banking crisis at that time. So, and now we go in the opposite direction. We've had this search for yield for a very long time, where investors have been looking for any yield at all, taking any risks at all to get something back. And of course, when this changes almost overnight, I would be very surprised if there aren't things that turn out very badly. And we've seen examples in Sweden on investments from pension funds. That is not strange. I mean, they've been living in one environment and suddenly that changes. So I would be very careful. And in Sweden, of course, commercial real estate isn't such an example. Being able to finance themselves almost to zero interest rates, attracting a lot of capital also internationally for a very long period, and suddenly everything changes. And we see some of them struggle right now to get a balance sheet that is usable. So I would be very surprised if we don't see things happen. What is surprising, I think, is that the banking crisis examples that we have seen so far is sort of plain vanilla, easy to understand crises. I mean, they have taken risks on their balance sheet, and suddenly we have a shift in interest rates, and they fall. But we were expecting crises to come from the sort of the capital markets instead, because that has been the movement now for a number of years, to see more funding coming from capital markets, less from banks. And there we expect things to happen, but still it hasn't happened from the shadow banking sector. That might be a thing that could create difficulties going forward. And what we also see is the new role for central banks. Not only, I mean, they were the lender of last resort for banks. We were concentrated on that. Why is that so concentrated? Now they have become lender of last resort for the bond markets. Mm-hmm. That's a new situation. They are responsible
maybe also for the stock market.
Yes, and maybe also for the stock market. And people are getting used to that. There is also always a response coming from someone to try to save a bad situation. So we've been super Keynesian for 10 years. In all of the world, and now sort of we see that it is a bit difficult to handle.
Johan, are you an optimist or a pessimist?
I don't know. I actually don't recognize the question for my personal private life. I deal in probabilities of problems, and I very much would echo everything that has been said. But I would put into the, call it equation, that for me economics and therefore anything that has to do with herd mentality or fear-driven decision-making, it's not a natural science, it's a social science. So psychology is the very big unknown in this instance. So what one do, like a banker, we are kind of here to worry all the time. That's what we do for a living. 6 million different Monte Carlo simulations every day on the probability of something going default. And right now we have had some new unforeseen events, which with the benefit of hindsight in the regional banks in the US, it's just mind-blowing. How could they have done this? Not only because of a lack of regulatory, call it efficiency, but just normal commercial acumen. that you know since biblical times you don't run a balance sheet that way. Borrow overnight and place it in 30-year credit obligations. And it's of course now when with the benefit of hindsight, I was at Silicon Valley in June. They are a very, very impressive startup bank with a new idea, trying to get into Sweden, very big in China, big in India. And we were also scratching our heads, how can you marry venture capital thinking with classic commercial banking risk mitigation thinking? And they've done that for 30 years. With the vineyards, that's where they started, and now kind of the startup community globally. Now I don't envy policymakers, because I really am worried that we are doing too much guarantees too quickly. We are taking out the risk-reward allocation. Moral hazard is a real big problem, and adverse selection a big, big problem in the financial markets. Because if I'm guaranteed all the time as a consumer or a corporate, I won't care who I give my money to, because the government has supported me. That creates dislocations per definition. On the other hand, you cannot not do that, because the cost of having a bank run in a more systemic manner is so unpalatable that you will absolutely. It's a cost-benefit analysis for society's balance sheet and P&L. And we'd rather not have this little thing in regional banking US spread. Now, what I would just introduce to this, for me, the shareholders and the equity providers of the financial system are always forgotten. We talk about capital like it's a thing that you sit on, but in the end, the only commonality in all the 5 now we've had, I bet you we will have another bank being privatized over the weekend. It's like normal now. Friday, we have a bad day on Monday, the bank struggles all week. Friday afternoon, the FDIC, the Federal Deposit Insurance Corporation of the US, the ones who carry out the bank guarantee practice, they take them on Friday, they call in some bank CEOs from reputable banks, and some of them will own them on Monday, and we have one today. So we'll see what happens. It's the 4th weekend or whatever in a row in the last 2 months. But the equity providers are the common denominator. There are different reasons trust is being lost in a financial institution or a government, but it's always the equity provider in the end that goes back. And that's when thing happens. Then you can have communication, bank death by Twitter, a very new phenomena, which we're very worried about right now. That's the rumor mill is on turbocharge because of social media, and we hadn't had a financial, call it trust-driven weakness in this type of environment where anyone can say anything, particularly reputable people in Silicon Valley or of other nature, and you will see hundreds of thousands, if not millions, following them in seconds. And now with digital banking, it's a real concern that you can take out hundreds of billions of dollars in one day. So we had $40 billion in Silicon Valley, we had 46 in Credit Suisse, and both times it was the shareholder of those institutions who in one shape or form said, no more support from me. And then that failed equity raising that SVB tried to do overnight, and the Middle Eastern #1 owner of Credit Suisse who went out on Bloomberg that morning and said, not $1 more to this institution, thank you, I've supported it enough. He's fired today, by the way. Which is also a new phenomenon, that you speak that way, you will have consequences which were unintended. He was, of course, thinking about his fiduciary duty and forgot that there's another one, and that's for all of us. And this is a very complex situation. So right now we are, of course, having a big problem in Europe with we want to have both eat the cake and save the cake. So we would like to tax the banks because we have enormous profits coming our way that we are not deserving of because rates went up. It's just a natural consequence when rates go up. It's short term, it's temporary. That is the #1 defense from financial crisis. Stable, sustainable business models in the financial system where profits are the first thing that go. So don't take it away. You increase the probability of default every time profits go down. Capital is not the issue, but we are still fighting the financial crisis. It's kind of going away now, but I've argued all the way, capital is not the issue. Capital will not solve a liquidity run. Credit Suisse didn't have lack of capital. SVB didn't have lack of capital. They had lack of profitability, which meant that you are no longer safe. As a shareholder provider for this, you don't think they will make it. And that that was Credit Suisse for decades, I would argue. And now, in good times with falling rates, no bad, unsustainable, call it accident-prone business models, they're never challenged in good times. They're challenged in bad times. And therefore, I agree with Thomas. Accidents are more likely to happen now than in a long time. And we assess the probability of who's accident-prone, and that is an elevated risk at this moment.
I think about the long term, hopefully we will stop this kind of financial stress quite soon. But if we think about the medium and long term consequences of what we are seeing right now, Because you can look at the different surveys. It looks like that, well, borrowing costs are going up, and the access to credits is becoming weaker. What kind of implications will that have on, well, investments? Because we have to make lots of investments going forward. Because as I said before, we have the climate crisis, we have the well, geopolitical situation. We have to make much more investments in defense, etc. How will the financial stress that we see right now, how will that affect the credit market going forward? Carolina.
Well, as I sort of alluded to in the introductory remarks, I think it is important to try to avoid that you get sort of a credit crunch and that impact negatively that depresses investments, because that leads to scarring of the economy.
Credit crunch, that is a very strong word.
Yes. Yeah, so
do you believe in that we could get that kind of situation with credit crunch?
I mean, in situation where there's more stress in the banking sector than what we've seen now, because up to now we've just seen individual institutions going under, and they have been dealt with quite swiftly by relevant authorities. But if you would see a more problems that spread more or were more systemic, I wouldn't call this a systemic crisis. Then, of course, there's a risk for credit crunch or significantly worsened credit conditions. But that's what we need to avoid, obviously. I mean, that would be my point. It's important to ensure that we avoid that situation. But there's, of course, and that's how I interpreted your initial, or the beginning of your question, that when you make the assessment of what you're going to do, you also have to consider what are the more long-run consequences of the measures that you introduce. And then you do have the worry about moral hazard and these things when you go in and guarantee more things, or you put government money on the line or take over risks from the private sector in various ways. So, I mean, it is a trade-off.
What makes me a bit worried that is that we have a situation that, well, and Johan mentioned that we have this kind of digital bank runs that we haven't seen before. So the speed is quite important. And that will also have implications.
We have in this part of the world, so we are becoming the go-to country for all the American international banks who did not have this during the Euro crisis or even in the early 90s, where we were so early on. So we are the only one who, last financial crisis, we did have everyone signed up for digital banking and online banking. Exactly. But no other country or bank has experienced this before outside the Nordics, more or less.
But what makes me a bit concerned, that is also that if we have this kind of high-speed developments when it comes to the financial sector, then we also need central banks and regulators to also have a high speed. And I think there is a risk that you have to react very quickly with, well, hopefully you will solve some problems in the short term, but it could have long-term negative implications. Any reflections on that? I'm thinking about Credit Suisse, for instance, when the authorities provided support to Credit Suisse.
It seems to be a pretty interesting structural change in how we view funding of banks. I mean, because traditionally we always said that's deposits, that's the safe side, and we are very concerned about the bond issuance and the markets and the exposure, and especially in Sweden that has been the debate now for a very long time. But already many years ago, I heard many Swedish CEOs of banks say that beware that what is happening on the digital side, on the deposits. We are going into a situation where maybe bond financing on the markets, there you can really see what are the maturities, when are you going to refinance, but when you have the deposits, things can happen very quickly. And now we saw that example coming from the US. We see that also in our role, we see the demand increase for our lending is a very significant change. And the role of a long-term stable financer is becoming very important in this stage. And the sort of cooperation that we have also with a lot of commercial banks in Europe and outside Europe on supporting financing of SMEs, we become more attractive in being there as a more stable financer. But also for project financing, we have a much more risk-averse situation now. What is going to happen with the needed long-term transformational investments that we all are discussing due to climate change. Since we have this risk-averse culture coming very strongly, I think we have a role to play here to bridge some of that concerns that private investors might have.
Johan?
Yeah, I mean, we are constantly changing our view on the financial system. There is no permanent state to be desired or that we've had or will have today. So my view, this will change. If there's a permanent shift right now, there will be, because there are constantly permanent shifts. What happens now, I think, is just a very welcomed, if I'm a little bit, step away, welcomed reminder of many things. For example, diversification of risks. We haven't cared about it, honestly, for 15 years, because it was impossible for 15 years to buy any asset. Housing, equity, bonds, FX, commodities, you kind of make money everywhere. And you forget about some real basics, like to have a well-diversified situation, diversity of response. So you have a country that some companies actually do well when things go bad, some go bad, and that, depending on what happens, it's just a good reminder. Governance, there is no substitute for good governance. Very good reminder for everybody, because this is what's triggering in the banking sector. It's poor governance. We knew that these banks have challenged business model, concentration risks. That was not the problem. It's the governance of having those risk mitigation, call it rule book in place, that has been lacking. So it's a reason why the failure, the weakness, is spreading to become much more accentuated than necessary. There is no substitute for good governance. Deposit diversification is one of the least interesting topics for a banker. I've worked 26 years, and I say 1 quarter per decade. It's an interesting discussion to have with our clients, because people typically don't care. This is that quarter. It's a good reminder that if you do have a lot of deposits and you do have guarantees, but only up to a certain level, just think it through. So you have a personal economy, and the company, and particularly the large corporate financial institutions, have put the right mitigants in place, because disasters may happen, but it's very bad if you haven't thought it through. At least you can have calculated risks in this system. And then the big unknown now is, of course, what's a very legitimate discussion. What regulations should we change, tweak, or introduce with the learnings that we are currently accumulating from what's happening around us? And I do hope, I was at the Eurofin thing here now, and with the IMF and ECB and everyone was there. And I do think that they start with, at least comparison now, is that Europe has probably had a little bit better look on liquidity, which is kind of the new thing that we all need to think about. But obviously, this is a legitimate time to take these learnings, see how we can make it even more solid. And that could have, depending on what they are, some effects that are here to stay.
Mm. Good. I think we are running out of time, but maybe a final question for you. If you should give, in this kind of, I think, challenging environment, and right now we have this kind of financial stress, what would be your best advice to, say, corporates and financial institutions? How should they look into the future? How should they react? How should they behave? What kind of decisions should they make? Should I start with you, Johan?
Okay. No, I mean, I think we are different. All people are different. All companies are different. Sometimes, in good times, you should be an excellent person in finding growth, capitalizing on it, and that's the way you grow. Mm. Other times, you need to be an expert in risk mitigation. Mm. It's about not finding growth, and some of us will have to try to be both at the appropriate time. Right now, it's the risk mitigation year. Mm. So my advice, for whatever it's worth, would be, if you're a growth company, don't think about growing 23, 24. Think about navigating very tricky terrain and come through it. So 2025, you're still here, and you can have a better, bigger possibility to grow. This is the 2001 learning by far. The IT bubble, the ones who actually managed it and were in the infancies then, they are called Google and Facebook and things like that today. So this is the risk mitigation year where you can just you don't need to show the bank, if you have a relationship with that you grew in 23 or 24, if that was your kind of selling pitch a year ago. Now it's about coming through this in a stable, mature and wise fashion. The other one was don't take decisions when you are fearful. And that's, I mean, I also struggle. We all become fearful. Fear-driven decisions tends to be very unwise.
Good, thank you. Thomas, Carolina?
We had a lot of discussions in management and with the board members when first COVID hit and then the war came and the effects on the energy market. We will have a full-blown energy crisis. Should we as a climate bank that just a couple of years before this had decided not to finance gas, oil, coal-based energy production, should we throw that policy overboard and sort of do what is needed right now? Finance gas and coal and whatever to people can get electricity and heat. But we stayed on course. I think this is very important to remember, even in a crisis situation, what are the real big issues for an institution like us? It is climate change, and it is the investment needed. So we decided to stay on course and instead have increased to support Repower EU initiative from the Commission, increased our lending into renewable energy, energy efficiency and grids quite substantially. And I think that has for us been a learning lesson. It was not easy because there was a lot of requests for us to scrap the policy and do whatever is needed now. And I think a lot of actors have to think about what is the most important thing now in the medium and long term.
Good, thank you. And Carolina, finally.
Okay, so I'll try to combine a little bit of what Johan and Thomas were saying. So obviously in this kind of fluid situation where things are sort of changing and you don't really know what the new long-run situation is going to look like, I think it is very important with risk management and to have focus on your risks. But at the same time, I mean, this where we are now, there are these huge investment needs that you have mentioned. I mean, it's climate, it's defense, it's energy. I mean, of course, in many countries, there are also lots of needs regarding infrastructure and all kinds of needs out there that creates opportunities. So there's no lack of opportunity in this environment.
Good. Thank you very much. I think we give you a big hand. Thank you. So that brings us to the next session, and we will get a presentation from the chief economist at EIB, Deborah Revoltella, and you will tell us about the latest survey that you have conducted about the situation in Sweden, investment survey. So please, go ahead.
Thank you very much, and it's really a pleasure to bring a few new elements to the discussion. And what I will present is actually the result of the work that we do at the European Investment Bank. I actually present two things. Part we have every year a huge report that we just publish, and you will find at the door a small QR code that you can take, and you will find the report. And it's an analysis of the investment situation in Europe and what we consider the challenge that will have to be addressed on the policy point of view. And this is also based on a survey of firms that we run every year in Europe, which also has a component for specific country, representative for every country. So what I will present is a bit of the combination of the two, and you will also see what we see in the Swedish economy, and actually another report that you can find at the entrance when you go out. So now I finish with the advertising, and what I see, the main message that I wanted to pass with with my remarks is that, and I distinguish between Europe and Sweden. Europe, where we come from, we have a lot of concern on, we can call it a polycrisis. I don't like very much the term, I think, but I really talk about uncertainty and many factors that we don't know that may affect the economy, and that's European side and also Swedish perspective. In Europe, we have another very clear element, and that's what we call a gap in terms of investment that is particularly dangerous in the moment in which a lot of investment is needed for the structural transformation. This is not really the case in Sweden. In Sweden, actually, I will show many things that are more reassuring in terms of investment dynamics, rather compared to what we see at the European level. But what is also happening in Sweden, and maybe more than in other part of Europe, is more change in sentiment, concern on the future development. So there is something going from relatively good structural features, at least on the investment point of view, but then a lot of negative sentiment that is coming in, and that most likely will have an impact on the macro side. So that's in a nutshell where I will go with my presentation. On the macro point of view, and I start this from the European perspective, if you look at the Commission forecast, and the way I do it is really looking at different moments in which the Commission staff was forecasting economic dynamics, what you see, particularly for 2023, it started relatively positive, then going down, 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 but the latest forecast showed that actually at the European level there is the assumption, if you want, the forecast that the previously assumed recession or risk of recession could be relatively be muted, and actually there is no anymore in the embedded forecast an assumption of recessions, but with a huge uncertainty coming in. And what I was trying to put here is a number of elements of uncertainty that I think are quite important, starting from understanding what's really happening on energy markets. We have been surprised on the capacity of the energy market of the European economy to manage the gas crisis and transform. And actually, we had an exceptional positive development during the last winter compared to what was previously assumed. But the concern of what will happen next and how much the energy market can really structurally transform, and then even facing the next winter remains some sort of concern and potential volatilities. The stickiness and persistency of inflation, I think there is a lot of discussion on what does it really mean, and what the monetary policy reaction will be to the persistency of inflation. The financial resilience of household and corporate, that leaves a lot of question mark because it's also based on exceptional policy support of the last years. So what will really happen? What is the true financial standing of corporate households without this exceptional financial support, when the financial support and the buffers generated in the last years are really depleted, and with the tightening of financing conditions coming up? And then the government rule in the economy, again at the European level, we saw a very strong presence of the government sector supporting other sectors of the economy, but we also know that this extremely present rule of the states will not last forever, particularly if fiscal consolidation will come in at the European level. And then asymmetries and divergence across the EU. This is always the elephant in the room when we talk at European level. What will really happen if we have a normalization of policies and if the divergence across countries continue? And in all of this, the globalization framework. So I spent a little bit of time, but really to tell you that yes, the Commission forecasts say no recession this year, but the concern and the uncertainty remain extremely strong, and this weight on economic factors. Then talking at the European level, one of the main messages that we have is actually a concern in terms of investment. And why do we come to this concern? We have a number of indicators in the studies. One is something a bit ad hoc that we developed, the concept of productive investment. We take out the residential real estate. And what you see is something that opened at the time of the sovereign debt crisis, a 2 percentage point of GDP gap between the EU and the US that has been remaining all over the year, sometimes closing, sometimes widening, but it's if you think it in a cumulative way, is a lot of investment less happening in Europe compared to the US at times in which you really need to invest for the digital transformation, for the green transition. So for us, there is a concern on this productive investment. It's not in all countries, and I will show you actually Sweden is quite good. I was surprised when I saw the data, but it's something overall at the European level that is a source of concern. Another element is the share of firm investing in innovation. This comes from our survey. You see that over time there was always a gap EU-US that is now even widening much more. So this is not only the innovation side, it's also the adoption of innovation, and we see that European level we have some area concern. And then the full annual investment needs to meet the net zero objectives, and here you can calculate in various ways, but it's a huge need of additional investment that you have to put on the plate if you really want to reach the net zero objectives. So we come at the European level with a message. We need some care in economic policies for investment activities, and that's the message on Europe. If we look at Sweden, Sweden actually is somehow in a different perspective, and I show you here what we see in terms of productive investment actually is quite good. It's better than Europe and the US. In terms of share of firm investing, the gap versus the US is smaller for Sweden. Is still, and also the dynamic, if you want, in the last year. And that's actually something that we see that in the Swedish economy, firms were actually quite fastly reacting to the pandemic, moving toward digitalization, and I will show it later. And actually, if you see at just the dynamic of investment, you see a lot of rule of corporate investment, and also a bit of household investment, but corporate investment in the last 2 years. So actually, the dynamic on investment for Sweden are actually a better starting point. If we look at public, now I speak Europe and Sweden, and I look at public investment and then private investment. This is for public investment, and actually for public investment, what we see is compare differently from with what we saw at the time of the sovereign debt crisis. Actually, public investment is holding well, and it's holding well because there was a lot of policy push to hold up public investment. The Recovery and Resilience Facility is one of the factors related to that. In Sweden, even more, a lot of public investment coming in. But what we are concerned at the European level is something that I show on this side, and it's coming from a survey of a municipality. What we see is that the absorption capacity of large public investment programs is really challenging. And actually, what you see is that the municipality themselves, they say they don't have the skills to manage these huge amount of funds for public investment coming. They really don't have a skill for environmental and climate. They don't have engineers or technical skill, digital skills. So the absorption of capacity of this fund is really the binding constraint on a few countries. And actually, it's not only countries that you could think like my own countries or other, but it's also, if you talk in Germany they really say we don't have the capacity, the technical capacity to execute all these investment funds. So at the end, this is the skill gap comes out very much also in terms of delivery on public investment. And public investment is very important also for the complementarities with private investment and the fact that it can be catalytic on that point of view. I move to private investment, and again, I end up being the positive one on Sweden, even if I don't want to leave you with a positive message. I'm not so positive, but I have but I have a lot of positive graph. So what I show here is coming from our survey. We ask firms how they face the pandemic, and actually, if 2022 actually would be better or worse than a pre-pandemic period. And what you see is a lot of green, and I don't explain what all of this mean, but basically green means I am better off, even if I was affected, I'm now better off than pre-pandemic. And actually you see that at the European level you had a pretty a lot of firms that actually recovered well from the pandemic, and in Sweden even more. And the dark greens are those that were never affected. So they passed through the pandemic with no shock. And that's quite surprising, I think, because it's much better than what we would have expected at the beginning. There was a lot of policy support also in Sweden. In our data, we see 70% of Swedish firms that received the policy support, and mostly in the form of grants, so not to be repaid. So it's a lot of support going to the private sector. But what happened is also that firms took it as an opportunity to transform. And particularly in Sweden, they were very active in becoming more digital. So that's a kind of a positive element. We wanted a digital and green transition. Firms took a policy support, but used it in the right way. So it's a positive element. What didn't happen much in Sweden, less than the rest of Europe, but in any case, it's a law, it's a shortening of supply chain, because at the same time we also had a disruption of global value chain. There, the transformation is a little bit slower. We also look at digitalization, and I think we really see the fact that I was showing before, that Swedish firms took really opportunity to become more digital. Here we are looking at advanced digital technologies, and we see really that Swedish firms are quite good in Internet of Things, big data, automation with robotics. So it's really moving fast on the digitalization point of view. There is a large gap, small and medium enterprises and large firms. So there is a really divide. Tightening financial condition affect, but the situation is relatively, to start with, the financial position of companies is relatively good, but tightening financial condition are coming. And that's one of the area to look. But I look at another graph that is, we ask to firms what are the main barriers to investment, and thinking at long-term barriers, what you really see, and this is the dot is Sweden, the blue is Europe overall. You see that the top barriers remain skills, and then we have uncertainty and energy cost that picked up very much. But for skills, Sweden is much above also the rest of Europe. It's the top barriers everywhere. It's relatively more positive in the other dimension. If we look in terms of dynamics, availability of skills was always a problem, and even increased now even more. Uncertainty remains one of the top problems, 70% of firms. What really came up is energy cost. It's the same picture that you would have in most of the other countries in Europe. In some countries, actually, the energy cost is even higher, but that's the dynamic. But in all of these, we remain thinking at uncertainty, and I'm bit over time, but I will be quick. Uncertainty, what we try to do, and this is at the European level, we try to see what does it mean, uncertainty for investment, and particularly for investment in climate action and in energy efficiency. And what we find out is two messages. One fact is, and it's extracted from the energy efficiency. So if energy costs push up the probability to invest in energy efficiency, but on the other side, uncertainty is a drag to investment overall. When we look at energy efficiency, we remain with a net positive among the two. So in fact, the probability to invest in energy efficiency increases. And that's what we saw all over Europe, in fact. Energy efficiency going very well, because it's a short-term reaction and it has immediate return. When you think at climate action, their uncertainty and energy costs, they balance each other. You don't have this net positive, they actually balance. So to really push, use a crisis like this, an energy crisis, as a push for climate action, reducing uncertainty is very, very important, and that calls for very, very clear policy direction. And very, very clear policy direction also means working well with incentives, and sometimes the policy signal has not been completely clear. I skip this, maybe we talk later on what are European and Swedish firms doing in terms of investment. What you see is they tend to be relatively good in mitigation compared to the European average, but a bit less active in terms of adaptation. And just as a final point, I think European level we have a concern on overall investment and investment gap at time of structural transformation of the economy. We think that the policy should continue to look at passing the right incentive and also managing uncertainty, that is the best enemy for investment activities. For Sweden in particular, we don't see this investment gap. We see deterioration, and I didn't show it, but a very strong deterioration of expectation in terms of a business environment, economic environment that is coming up, but that's still on the expectation. The structural element on investment remain relatively good. So I think how to manage this deteriorating expectation and make sure that one leverage on the positive structural part and not get into the negative sentiment, that's something for policymakers. Thanks very much.
Great, thank you very much for that presentation. And now I think it's time to introduce the last panel for this seminar. So I would like to welcome up on stage, I would like to begin with Christian Danielsson, State Secretary to Minister for EU Affairs, Jessica Rosvall. And then we have also Anna Stellinger. There, you are Deputy Director General and Head of International and EU Affairs at the Confederation of Swedish Enterprise, Swedish Sveriges Näringsliv. Svensk Näringsliv heter det. Ja, Svenskt Näringsliv, sorry. Okay, that's good. And last but not least, we have also Alexander Artman, CFO of Northvolt. So welcome to this panel. Good, and I should also say that now you have an opportunity to ask questions. And if you participate via Teams, you can put your questions in this chat channel. So please do that, and I will check the questions that are coming in here. So, and I can promise you that this panel, they can answer all questions that you have.
No.
No, okay. Almost all questions. So, but let's start. I would like to ask you about. Now we have been discussing and listening to when we look at this kind of what I see as a very challenging environment. How do you look upon the current situation? Just a few reflections. So maybe I can start with you, Christian.
Start with me, yeah. No, I think we have got a very good description during the previous speakers and during the previous panel. It is challenging. But let us remind ourselves, it has been challenging before. And this is part of what Europe is about. and we have to stand up for those challenges. I think it's been well identified. Ukraine, of course, and the Russian aggression is a big challenge. It's a political challenge. It is a challenge of providing the support for Ukraine. It is the challenge of seeing to that those responsible for these atrocities are being put for justice. And there is also the challenge of the economy and the energy, in particular the energy market has come about it. It is the climate change challenge, which is obviously there. And it's a new geopolitical situation, which is also a challenge for us and which we need to address. Now, I'm a bit more positive, though, to Robert, what you outlined and also what perhaps came out of the discussions, because I think the recognition of these challenges are there politically. And you can see it from, I'm working in a European framework, so it's the European Council and what they are saying that is important for me. And you see clearly that those challenges are well recognized among member states. But beyond that, it is also coming out in concrete policy action. It is policy action in Thomas Östros and the EIB framework. It is policy action when it comes to now putting competitiveness of Europe into more of a priority. It is policy action when it comes to transatlantic cooperation. We have a TTC coming up in Luleå very soon. It is also recognition of the financial market and the need to address the issues on the financial market, capital markets union, for instance. And it's also policy action when it comes in particular support of Ukraine. So yes, challenges are there. They're going to be substantial. Climate change is one of them, clearly, and the others I mentioned. But I see the willingness and the understanding and also the way of moving forward to try to address them with the policy framework that we have and that needs to also be adapted.
Good. Anna?
I'm sorry, I will have to start off a little bit gloomy.
Okay.
I hope to end off on a more positive note at the end of the panel. But if you take a few steps back, what we do have right now, when you look out around us, around Europe, you have the United States turning inwards. I mean, clearly, we have a disengaged United States when it comes to a lot of questions and a lot of relations right now. If you haven't read National Security Advisor Sullivan's latest speech, please do. We have China with Xi taking an even firmer grip of the country. We have Russia being a white spot on the map and will be so for years and years ahead. We have India maybe awakening. But as we know, we all say India is always the future, but then the future happens somewhere else. This time India might be the future, but not there, not just yet. And of course we have EU taking on the challenges, and I agree. But we do see some tensions also between the European countries on what the way forward should look like. If you add to that the multilateral trading system with the World Trade Organization is hugely challenged. We have the geopolitical tensions that you mentioned. And we need to talk about Taiwan, of course, being the epicenter of both, semiconductor production, but also a huge global geopolitical danger. And then you add some ideas about the end of globalizations, which, by the way, I don't believe at all. We will perhaps talk about that. It does make a cocktail. It does make a mix that is quite difficult to grasp exactly where the world will be heading. But if Christian is positive when it comes to the political awareness and the actions taking, and I completely agree about what you say on competitiveness, bravo to the Swedish EU presidency there. I am positive still when it comes to the fact that we are recognizing the problems and we do have solutions. I guess that my partner here will talk about those solutions from Northvolt. But when I look at the companies I speak to every day, the Swedish companies, but also European companies, the sense of urgency, but also innovation, willingness, engagement, solutions to the digital transformation, green transformation. There's so much happening. So that kind of puts my worry down. But the geopolitical global context is challenging.
So maybe would you say that this kind of serious situation that we have right now, that will actually accelerate need for solutions and that will bring us also solutions?
Yeah. Definitely. Okay. And since I am where I am, I believe that a lot of those solutions will come from entrepreneurship, innovation, collaboration, where we need to come closer to our American friends, regardless of IRA. Definitely, there's so much happening. I am positive on that. part.
We will come back and talk more about IRA, the Inflation Reduction Act. But Northvolt, what's happening in your company?
Yeah, so maybe taking more the company perspective hat and talking about both risk and growth, as we have alluded to before. I think we see the challenges and a lot of them, and that we need to act quicker in a lot of areas. But we also see big opportunities. This industry we're in, and some of these strategic industries are being cemented over the next few years, and we are definitely part of it. You know, jointly with the partnerships we see, can enable this. On the challenging side, we see, you know, cost inflation, raw material prices coming up, cost of capital coming up. There are some geopolitical aspects you need to deal with, you know, and risk management is very important. But on the other side, you know, we as a company are based in Sweden, in the north of Sweden, where we see, you know, still versus peers, energy prices are okay. We are well capitalized, and customers are there. You know, they're increasing their demand, and they are transitioning. So it's also an opportunity, I think, for us and for Europe and Sweden to kind of diversify from others. I think one topic is priorities. You know, where do you grow, and for future investment, how fast can you take decisions to make investments on top of what you're executing on now? And there is a big discussion on IRA and the European and the Swedish response, which I find is very important.
And Deborah, any reflections?
I think I don't know where to position between. I very much see the challenge, and I very much agree that the deglobalization challenge is it's really something heavy on top of us, because at the end, I think the whole discussion on strategic autonomy is super important. The security part is super important, but the efficiency gain that we got from globalization, something I'm scared that we may have some policy mistake in between. So finding the right balance is extremely difficult of what is security and what is protectionism. And what I'm scared is finding the exact right angle to manage this trade-off. So that's one of the concern I have. I am relatively positive in terms of the capacity of firms to adapt. And I think that particularly at the time of the pandemic, we saw this transformation capacity of industry taking the challenge and transforming. And that's extremely positive on my perception for the future of Europe. It's actually very good. We move in the right direction. And again, the concern that I have sometimes is we have seen a lot of public support coming in. Sometimes incentives are not 100% clear on energy support. In some countries, you saw signals that don't go exactly in the right direction. So again, the risk is a policy mistake done for the right reason, but that weaken the incentive of transformation. So I think what is important in this moment is very much keeping this as an opportunity to transform and have more competitiveness at the European level, and balance all the risk on the globalization effect, strategic autonomy, or protection, social protection, etc. Assess all the negative incentive this may create, but still push for the creative destruction, if you want, in the system.
Coming back to the discussion that we had earlier this morning about the access to money and the cost of borrowing, do you think that the situation that we have right now, and maybe the implications of the financial stress, will that jeopardize this kind of green transition, the digital transition? Is that possible, that we have to slow down that kind of investments? Anyone who would like?
Well, I hope not. We have just been able to get the framework more or less into place for what is called Fit for 55, which is this huge transition in order to meet the objective of 55% reductions in greenhouse gases by 2030. And as we saw on your slide, there is a need for investments. We also will see a substantive need for investments once the war is over, once Ukraine has won the war, that we will see the reconstruction of Ukraine, and that to a very large extent will be private investments. So my understanding of what was said in the previous panels is, yes, there is a bit of risk aversion, but there institutions like EIB setting up the right structures when it comes to giving if you take Ukraine, I suppose export credits and assurances of various kind, but also the policy framework. It's going to be important that the path for Ukraine towards becoming a member of the EU is serious, because that is creating the kind of stability for investments. It's going to be important that the discussion that now will start up on the fiscal framework within the EU, that one is coming into place to safeguard that we in the future are going to have a stable macro financial framework within the EU. And it's going to be essential that the policy, various kind of policy elements that we have, that they are framed towards, I would say, competitiveness, which means a growth-friendly regulations, which means capital markets union coming into place, and which means substantive investments when it comes to research and innovation, to mention a number of such elements.
Now I have a couple of questions, and I have one for Alexander. And we will come back and talk, because I think we have to discuss IRA. But for Alexander, what decisions, policies do you want to see from politicians to accelerate this energy transition? So now you are the finance.
Yes.
Or the prime minister.
So talking about Northvolt and where we are in the transition, I think there's the discussion to have around the total transition in kind of risk taking now versus avoiding risk and economic kind of loss in the future, and then how you do it. But if you think here and now, what we see is clarity and acceleration on how we respond to IRA in Europe and in Sweden, and there are a lot of good things happening, but what we see is a totally different kind of package being offered in the US and also already in certain areas in Europe. But it would be good to get even more clarity, which I know is coming, on how the response is around the kind of European sovereign fund, and how we kind of can distribute and continue to keep the current industries we have, but build new competitive industries in Sweden. And so it's a topic for Europe, but it's also how do you make Sweden competitive? Because it's one thing is around enabling state aid rules, but it's also around the funding. How do you get funding into Sweden to match what we see in the US, where a country like Germany or France that have more muscles, they can do much more right now than Sweden can. And I think this is what is very important for us, and to see that there is an acceleration in general.
But would you say that Swedish politicians, that we are lagging our friends in Europe?
I think we are doing very good things in Sweden, and we have been able to get to where we are today, given the circumstances out there. There are certain countries that are very strategic and are executing, faster, I would say, and we could probably do more.
Okay, good. And of course we have the money, because Carolina, you have the money, and Thomas. Yeah. Yeah.
Maybe if I think that is a great step that we're taking. Green credit guarantees, enabling new projects, and I think as I said, many good things happening. But with that said, we need to accelerate more.
Let's talk about IRA. Anna, can you first explain what is IRA?
Oh.
and also your reflections about how EU is reacting on that?
Well, I think it's basically impossible to discuss any matter at the table currently without IRA somehow getting into the discussion. And here it is really relevant because there's been so much misconceptions and fears, and I think it was Torgeby who said that we should never take decisions when we're fearful. There's been so many anecdotes and so much confusion about IRA. So just a few points to make clear about what it is and what it isn't. First of all, it's not really about Inflation Reduction Act. It's about the green transformation. And secondly, it's not just good or bad. We've seen things with lack of nuances at some point from the EU. I would say that we really seriously need to welcome the fact that the United States is taking on the climate challenge. It's good for the global climate, and it's a good thing that the EU leans in and steps in. It's a good thing also that the US believes in and supports companies, consumers, believing that they are drivers in the green transition. And it's a great thing that we have Swedish companies, European companies who will be able to participate in this because we're good. We're at the forefront. We have companies being at the forefront of the green transition. So that's a good part. And then we have the less good part where there are discussions going on. And I think also discussions within the TTC are very fruitful. We'll be very happy to be part of the high-level meeting in Luleå by the end of this month. But there are the bad parts. The bad part is that you cannot build long-term competitiveness on state aid and subventions. I mean, that's not the way you build a competitive economy. And the bad thing, of course, is what we trade nerds called the local content requirements, saying that products to a certain various degree of percentage need to be produced on the US ground, or formerly NAFTA USMCA. And if the objective is really the green transition, it doesn't matter if it's produced in the EU or the US or elsewhere, for that sake. So there are problems, and the problems are not minor, because that will hit European companies who will not be able to participate in the green transition. It will hit subcontractors, of course, who will not find it that easy as perhaps Northvolt to go and expand in the US. And it also is not the final nail in the coffin, but it is a nail in the coffin to the multilateral trading system, because the US shows the world that we don't care whether it's WTO compliant or not. And if one country the size of the US does that, then really, what should the other 163 countries think about current negotiations? So that's the US part. Not just good, not just bad, but there are good and bad pieces and bits in it. My worry is the EU response. My worry is not so much IRA, because at the end of the day, $369 billion, when you compare to the recovery fund and what we are doing in Europe, is not that much when you look at the figures. But my worry is the conclusions that the EU will draw. Because at the end of the day, if we end up doing our homework, the IRA is a fantastic thing. If we end up throwing ourselves in a global state aid subsidy race, where China will pay for people being in China, the US will pay for US, and the EU will pay, and we will trigger ourselves in a tit-for-tat downward going subsidy race, I mean, globally, that's not a good thing. If the EU does the same on the single market, allowing for various countries to have also a state aid race between countries, trying to attract companies, then of course we will end up fragmentizing and weakening what we have as the most powerful and useful tool in the EU, our single market. Our single market is what has made us strong, what makes us economically, politically, and geopolitically reliable and strong. So if we end up shooting ourselves in the foot by relaxing state aid rules too much and thinking that we can push state aid and help us grow competitive, that will not be the solution. So that's why I'm so happy. Once again, this is, a scoop. The Swedish EU presidency will go down to history as the presidency that brought up competitiveness high on the EU agenda. Because that, in my view, is the response to IRA. It's doing our own homework, easier access to reliable energy, more focus on research and development, infrastructure, removing barriers to trade that we know are there, making it easier to do business within the EU, getting all those free trade agreements that are already there, just signed and sealed and get it done, because we've been slow. And if IRA and the US finally, and this will be my end point here, if the IRA and US finally makes us look at ourselves in the mirror as the EU saying, okay, we need to speed up, do our homework, make EU more attractive through a competitiveness agenda, then finally it will be a good thing and we will draw the right conclusions, but not a subsidy race.
I will ask Christian to respond on that, but just because I can hear when I listen to some companies and some other people, they are saying that how EU is now responding to IRA, that will decide the future of EU. That's quite dramatic. So what do you say, Christian?
Yeah. No, I think Anna, you pointed to IRA and also the challenges there. As you said, primarily it's a good thing that the US is back. It has a China angle. We should know that also. This is not only about climate change, it also has a China angle. Now, what has happened? I would argue that the reactions from the EU has already come. I'll tell you a little anecdote. We went around here in the beginning of the year and we met leaders. One leader said we should do exactly as US. Go ahead. Subsidies all over the place. Northvolt gets 8 billion in order to make its factory wherever it would like to do, and so on and so forth. That would have been, I think, rather damaging for the EU, for the internal market, for us, generally speaking. Now, what happened? There was a substantive focus by the leaders in January, February. It ended up in a package, and the package is negotiations with the Americans. And here we have come quite far when it comes to electric vehicles, for instance, where we will have same treatments as Canada and Mexico. Negotiations on critical raw materials, which are essential for Northvolt and other companies in order to be able to continue on the battery side. Continue the negotiations and discussions with the Americans. And to be honest, the Americans probably had not thought this over fully when they put it into place. So they are quite open for that kind of discussions. Second element, see to that the regulatory environment for clean tech in Europe becomes competitive. That's about permitting, that's about regulation, that's about the electricity market. And that's why it's looking into the review of that one. But that is also to look into how we can get more focus on clean tech industry within the EU. So that is the second element. And the third one is financing. And here, of course, some companies went around and said we need substantive subsidies. Otherwise, we're going to invest in the US. Now, if we would have gone down that road, I'm pretty sure that we would have that competition race that you described. So what happened? Well, the Commission is responsible here, and I think they listened quite carefully on the various views from member states, and it's clear that some member states are more keen towards state aid than others. They landed on a slightly widening scope for using national state aids, but it's still limited. 2 years, and it's limited to the sectors which are very clearly defined. So I would probably have argued for less of that, to be honest. But now that was where we landed, typical EU sort of compromise.
Nobody's happy.
Nobody's happy. But what we're going to see, I think, is that it will help us in order to address the issue of getting clean tech more up on the agenda and seeing to that we become even better on it. And hopefully it will be good for Northvolt as well.
Yes. I will also ask Alexander to react on that. But Deborah, you would like to make some
I just
reflections.
wanted to add, I fully share, and I don't repeat all the points that you made because I think they were super clear and perfect. I just wanted to mention again the issue of the single market and also the part of permitting. I think it's very interesting. We have at the EIB, we have a group of engineers that look at all projects over the world, and what they do is actually they look at projects that they do all over Europe, and then they try to find all the regulatory barriers or the permitting and elements that kind of fragment or impede the projects and fragment the market. And actually you find a very trivial thing. I think, I don't know, when I was a student, I remember I was studying the cost of non-Europe, the cost of this non-tariff barrier in the single market. We really see it happening. We really see it on the ground, and very much also on on renewable, etc. So a fight, a real strong relooking at all those elements and going against that, I think it's absolutely important. There are very, very stupid elements. I think the way I say, like this permitting on energy efficiency on product, where the scale, one country has the 3-star is good, the other one has 3A, or or it works in different way. But all of these fragments the market. Or the other thing, I was in Germany last week, I said it again, they were saying, yes, we have a EU regulation on a maximum permitting time for deploying a solar panel. We have now the federal law. The problem is that at the municipality level they don't know it, they didn't realize, so they are not adopting it, and they have to. It's really like how does it trickles down, but still we have a fragmented market. And then with all of this and with the whole uncertainty, I think it's very difficult for a company, and we all look at you, to make your long-term plans, not knowing what is the size of your market, how much is fragmented, and then all these changes, changing regulation is, maybe it's change for the good, but it's still change, it's still uncertainty. So I think that's the way where we have to go. A lot of simplification and integration in the market.
Alexander?
And that doesn't cost much.
Yeah, how to respond.
It's a lot. It costs.
You'll deal with that.
It may cost a lot of political.
That's his job.
Maybe just taking a step back. I think again, Sweden has a huge opportunity, and we are where we are based on where we are. You know, Sweden has good infrastructure, good energy grid, you know, good industrial heritage, entrepreneurship to build upon.
Good companies.
Good companies out there already that, you know, are strategically important, and we want to keep them, and we want to bring in some new strategic industries. We see permitting. We got our permit done in 7 months. I mean, we see opportunities in getting permits done as well, but of course you can accelerate it. And then there's capital. You know, we have been able to partner with policy, with the EIB from an early stage, enabling where we are today throughout, you know, very tough periods of our journey. And we see now the opportunity to continue that, going into kind of more expansion with Riksgälden and the likes. And that is why we are investing 10 billion euros in Sweden already, and it's like kind of 1.5% of the Swedish BNP. Now, when you are in the boardroom still today, and you take this as a whole, and you compare, you know, okay, green electricity, infrastructure, people, competence, and you look at kind of, okay, this is what you have, you can do in the US, this is what you can do in other countries in Europe. There is a fiduciary duty to weigh that, and as you make the decisions, and I really hope that, you know, we will continue to invest and build strong, competitive, sustainable industries in Sweden, given how we respond now.
Yeah. Question about because this is one of the priorities for the Swedish presidency of the EU. We should become more competitive, or the EU should become more competitive. Well, you could say that I have heard that before. We have heard that from Swedish politicians, and we have heard it from EU, that we must become more competitive. What is different right now? Yeah. And should we expect that we will become more competitive? Because it's quite obvious that we have to become more competitive.
Yeah. Well, I mean, this is the $1,000 question, isn't it? If you ask me, I think there is I was there in 2000. I was there when the Lisbon strategy was adopted. Europe should be the most competitive economy worldwide, more or less. It didn't really happen. But I think this time for the reasons, for the challenges that we have discussed, there is a recognition that is even stronger than it was in the end of the 90s. It's a fact that Europe has grown with around, in average, 1% over the last 10 years, whereas Asia and the US has grown 6-8% per year, 4-5% in the US. It's a fact that companies do not grow in the same way in Europe as they do in Asia or the US. It's a fact that productivity figures are less, impressive in Europe than they are by competitors. Now, I think this is recognized, and seeing the challenges, there is the understanding among leaders and among politicians, I think more broadly than before, that if we want to be able to deliver growth and prosperity and be able also to have a strong role externly, we need to see to that our economy is growing better. So that is going, I think, will be the geopolitical drive for it. Now, will we do it? At least we have put into place a kind of long-term strategy now in March this year. The challenge now will be to see to that one is being implemented. And it boils down to what I said, a more growth-friendly regulatory environment. It grows down to more investments in research. It boils down into seeing to that the capital market union functions better. And it boils down in seeing to that the internal market is fully exploited. And that's going to be heavy lifting, that's for sure. But I think we are at a better place today in this respect than we were 5 months ago. And the sense when you follow what is being said by President Macron, by Ursula von der Leyen, by Scholz and by the other leaders, and also the kind of discourse that you have in member states, it's much more driven towards let's try to address this issue. One issue which will be a major one, which we haven't discussed, Ray, is the whole issue of competence and seeing to that we have the workforce and the competence in order to take on the transitions, the growth, the competitiveness. And that's something which calls for a substantive reflection, which has to do with migration, has to do with education, has to do with our universities. And I stop here.
Anna?
Thank you for offering me a possibility to end on a positive note, because I am too an optimist about this, because things are different now. There has not been a real true focus. There's been a lot of talk, but not a real true focus on competitiveness since approximately 13 years back in the EU. And that's a long time ago. The world has changed. It's a new world we're living in. As Christian is saying, we're lagging behind. There's a new geopolitical context. We see that we really have a sense of urgency when it comes to building the EU strong. And we don't build the EU strong by autonomy or sovereignty or protection. We build the EU strong by building competitiveness. What I like about the proposal, and what I like about what we have seen so far on the competitiveness strategy from the Commission, is that it is for the long term. We're looking at 2030 and beyond. And that's what we need to do when it comes to competitiveness. What I like too is that it's based on productivity. I mean, it should be clear. It should be a no-brainer, but it's not always a no-brainer. We must become more productive. And what I like too is that there are KPIs that member states will be able to turn to the Commission with. And the Commission will be able to turn to member states and say, hey, what's going on in this field? So it will be measurable. It's for the long term, and it's on productivity. And the last thing I like about it is that, I mean, without taking away any of the benefits of the competitiveness agenda that you've been working a lot on, there's nothing really, really new. I mean, there's no fantastic silver bullet here. It's just taking all those things that we have been talking about, common sense, better regulation, faster processes, less administration, removing all the barriers we already know on the single market, easier access to skills, to infrastructure. I mean, but just putting the energy and the emphasis on that, not protecting the EU, but building the EU strong, because a stronger EU economically will cope better geopolitically as well.
Good. Actually, we are running out of time. I have three very short questions that I will ask you, and there you can just answer yes and no. But before that, maybe a short reflection from you, Alexander, because Deborah said that we have skill gaps. And I'm thinking about what you are doing in the northern part of Sweden. I think about housing market that is now collapsing, if I should be a bit dramatic, and how can you get the right people
Exactly. I mean, this is a big topic for us, one of the biggest that we have had since we started up Northvolt. We're 4,500 people right now. We're 2,000 in Skellefteå that we have recruited, and they're working there today. We have 120 different nationalities due to some of the aspects you're talking about. You know, where is the competence? There's certain competence here in Sweden and in Europe, and there's certain competence you need to import and make available and make sure that, you know, there is an ability to do so. We have been, you know, quite successful so far. We've been an early mover, but it is a challenging topic. And when we look at our peers, this is a very challenging topic. In the north of Sweden, in Skellefteå, we have great collaborations with the municipality here as well. Housing, universities, international schools, infrastructure in general are all very important aspects. And so far, I think we've been a good example of what you can do, although there are always bottlenecks in the system, how you can enable both the number of people and the certain competence and training of those people.
Good. So let's take my three very short questions from the audience, I should say. The first one, and you can choose if you would like to answer this question. The first question is about, can we now call off Europe's energy crisis? I will start with
Energy crisis? No.
Energy crisis? No?
No.
Definitely not.
So you are still worried about the
Yeah, worried. We need to build up supply. We need to build nuclear energy. We need to move ahead with fossil-free energy substantially.
Yep.
And there you can see it's not that easy.
No. You all agree?
Yeah.
Yep.
I
Good.
think we don't have yet a stable long-term solution. We are in between a transition.
Yeah. My second question, or the audience question, that is about the risk of greenflation. That is, green transition will generate inflation. Do you think that we will get more inflation from this energy transition? I will ask you, Deborah, to start.
I don't know. It's very difficult to really assess what the effect of the transition will be on inflation, because I think it really depends on how it evolves, etc. For sure, we have seen a part of the effect of the energy crisis on inflation that we have seen. On the transition, it really depends on the path of transformation and how will affect. It can be inflationary and deflationary. Yeah. So it's difficult to say what the net balance will be.
Alexander?
I don't know. I mean, it has to happen, right? You know, both current industries, every all the industry needs to transform, you know, and go green. You know, I think it needs to be managed.
Green transition is not an option; it has to happen. So we will have to deal with inflation if that happens.
Okay, good. And my final question, or the audience final question, do we have a problem with the Swedish krona?
Oh.
Maybe a sensitive topic. Anyone who would like to answer that question?
I'll leave it to you.
Please, feel free.
I mean, from our perspective, I think we manage this, but you have to. You know, you buy in dollars, you sell in dollars, you have some exposures on the capex project, and you need to hedge and so on. I think it's a bigger debate for these guys.
And it's a huge debate, of course. But when you point at uncertainty, that is also something that should be included.
Good. Thank you very much for this discussion.
Thank you.
And finally, I will ask Thomas to come up here on stage and make your final remarks.
Thank you very much, and thanks for a fascinating discussion. There's a lot of people to thank, but I will concentrate on two. Carolina Ekholm, thank you so much for doing the keynote speech. You laid out the macroeconomic framework and the risk of scarring effects of crises, and that much of the policy debate should be about trying to avoid those effects that could be with us in the longer run. And I would like to pick up on Christian Danielsson also, because I mean, it was amazing. He was here the whole morning, the State Secretary for EU Affairs during Swedish presidency, highlighting the importance of what the European Union has been doing in recent years. it has been a cooperation that has been very forceful and very powerful. And as in many crises before, also created new instruments on the way. Can you imagine that we have now a recovery and resolution facility where the Commission is borrowing loads of money on the international capital markets, green bonds, a big issuer now, to support member states in their fight against a recession. That was something that was completely unthinkable just a couple of years ago. Very comparable to what the ECB did during the Euro crisis, when they really stepped in as a central bank, totally comparable to the Federal Reserve. The last words from me on the EIB side is that we discussed energy transition. We are focusing a lot on that. We are also working a lot on innovation. Northvolt is an interesting partner for us in that respect. As you mentioned, Alexander, we were there from the very first beginning, financing the demonstration plant in Västerås. You know, it is not easy to get the financier for a demonstration plant, reaching for a greenfield, huge investment, becoming the largest EV battery producer in Europe and a world player. We were there thanks to the guarantees that we got from the Commission, so that we could take that type of significant risk. And since then, we've been with you in financing also the plant in Skellefteå, and we are now discussing the future very intimately with you and your colleagues. So this is where we want to position ourselves as a bank that can crowd in private capital. We are, of course, very concerned, and for us it's very important to see the private capital come in. We don't take a step forward without having that reassurance. But on the other hand, they do not come in these type of projects if you don't have a long-term financier behind themselves. So thanks a lot. This was a great event. I promised only to thank 2 people, but I also must thank a third one, Robert. Excellent leadership of this day today, and I see when you ask your questions, you are full of answers yourself. So maybe next time you could be part of the panel and we can listen in to your views also. Thank you very much and have a nice day.